So this is our second part, pricing decisions, profitability, and cost management, part two. So in this particular part, our target is to understand these all three strategies of pricing. One is target costing, cost plus, and life cycle budget and costing. So all the three. This part is only focusing on these three pricing strategies or way how we can. So steps in developing target pricing, prices and target cost. So these are the 5 steps we have to use in order to figure it out the price. Why we need to follow these steps? Because in this, the price is already targeted, and now we have to adjust the things so that we can achieve that price. So develop a product that satisfies the needs of a potential customer. So the product should be like this, that it should fulfill the needs. It should not be so substandard also that it cannot be fulfilling the needs of the or the objectives of the customers demand. Choose a target price. So as I mentioned that we have to choose the target price. Like if my competitors are selling at $10 per unit, so it means our target price is $10. Now we have to adjust the cost, keeping in view the quality should not be compromised, that how we can achieve that target price of a $10 and also we make profit out of it. So that's the way. Drive a target cost per unit, target price per unit minus target operating income per unit, and perform cost analysis, perform value engineering to achieve the target. Now we do value engineering. Value engineering means that we want all our best. We do all our best to reduce the non value added costs, non-value added cost. Value added cost cannot be reduced because by this way we compromise the quality, which cannot be affordable in a market environment. So we have to reevaluate the whole process, and we should reduce as much as possible the non-value added costs. So let's value engineering. Value engineering is a systematic evaluation of all aspects of value chain with the objective of reducing cost while improving quality and satisfying customer needs. So as I mentioned, the price is targeted. Now we have to change the cost in such a way that we can be able to sell the product at the target price with a profit. So managers must distinguish between value-added activities and cost that non-value added. So activity and cost. So we have to be careful when we are deciding whether we should compromise on this particular feature or this particular attribute of a product or not, because that's going to affect our cost. Now, it's very common in the trading world, like when you want to import something from China. So the Chinese are not asking that or offering you certain price. They say, okay, in at what price you want to buy from us. So basically what this is the same thing what we are talking here, target. So if a customer is from this Western world. So they say, okay, because we are going to pay in dollar terms. So we say, okay, we this price. So they're going to produce the product according to that price. If the customer is from the underdeveloped world, so they're going to offer the price. Okay, we want the product in this price. So they're going to give the same product with this price as well. Now, where the difference? The difference is the quality or the attributes, the features that is going to be different in those products. Although the name or the main concept of the product is same, but the qualities are different. And you can do that experiment if you are able that you buy a same product made in China from US or UK or Canada. Or you can buy the same product from anywhere else made in China, but in the other countries. You will feel the difference. And the difference is because of the this target pricing, that they want to target the price. Because when they convert the US dollar or Canadian dollar or UK pound into the yuan, their price is different as compared to when they convert it into any other currency with the yuan. So that's the reason that you can find the difference in the quality and the quality is different because of the target pricing. So value engineering technology, value added cost, a cost that if eliminated would reduce the actual or a perceived value or a utility usefulness customers obtain from using the product or service. So value added cost is all the cost which we add into the total cost for adding a feature or a attribute or something that customers find it useful. Non-value-added cost, a cost that, if eliminated, would not reduce the actual or perceived value or the utility of the customers obtained from using the product or service. So product is not compromised. If the cost the customer is unwilling to pay for. Cost incurrence. Now there are two types of cost incurrence and cost logged in cost. So we say that cost incurrence is described when the resources is consumed or benefit foregone to meet a specific objective already done, already spent, or already consumed. But logged in costs are the cost which we're gonna do in future, but we know that it is fixed, that we cannot change it. So our costs that have not yet been incurred, but based on decisions that have already been made, will be incurred in the future, are a key to managing cost well. So this is a logged in cost is the key for managing cost well. Like we can increase, but that's a before going into logged in. If it is logged in, if we already made a decision, then we cannot change. We cannot change. So this diagram is reflecting that the difference between the in cost incurrence curve and the logged in cost curve. So we see the end point. This end point is same. Like this is going to be our the cost. But if we make a certain decision here, so already research and development and design cost already incurred is less, but we know that if we step in for this research and development, this further cost we're going to done. And then we see that after that, the manufacturing cost is not so much logged in. It's very not so much different. So we see that the management has to make a decision before starting the project design or research and development that how much cost we can incur. So decrease. Now, what is the problem with the value engineering and target costing is that it decreases the morale if performance targets are not attained. The employee, the workers going to be demoralized if they know that we are not able to achieve our targets. Compromise in product attributes results in a poor design. That is also one of the, like, in order to meet the target of the price or a target cost, the product is compromised. Missed opportunity because of a longer product development time, and we can miss because some opportunities are very short-lived. So we have to make a decision within that time. And if we are not able to do that, so maybe we're gonna miss that opportunity of making profit. Unequal burden of cost reduction results in a functional conflict as non-value added costs are eliminated. And that also create a rift within the organization. Some people think that we are doing a work which is value added and we are really contributing in the profit of the business. And some people have a opinion that we are not adding up value. So we are not, we are just a burden or we are just a cost center, not the revenue generating center. So by this way, there is a conflict or there is a little bit rift or not a teamwork type, which is required for a successful manufacturing or producing is affected. Now, cost-based approach here which is very simple and understandable. The general formula add a markup component to the cost base. That's a very simple and understandable. Like this is the cost base and we want to earn 10%, 20%, 15%. We add on top of that cost as our profit margin, and then we set the price. So here is an example. Usually it is only a starting point in the price setting process. Markup is somewhat flexible based quality and the competitor's price, based on the quality of the product and the competitor's price. So pro value example is the cost for full product cost per unit is 720, and the management is decided that we want to earn 12% profit on it. So they add up 12% of 720, which is 86.40. So by this way, the pro value prospective selling price is 806. So it's very simple that we are adding up. Now, setting a target rate of return on investment, ROI, that we want to set a ROI. So ROI is a target operating income divided by the invested capital. Now, selecting different cost base for the cost plus calculation, variable cost manufacturing cost, and full cost. So invested capital, if in the business is 96 million, and we want to earn 18% on it. So we decide that the target income should be of a 17.28 million by 18% on 96 million. So target operating income per unit should be 17.28 million divided by 200,000 unit. If we assume that we this firm is going to sell 200,000 units, so should be of a 86.40. So you see 86.40. So we can also calculate the markup based on that how much ROI the investors are interested to get. Alternative method of cost plus method is cost plus pricing begins when with some form of product or service cost and adds on an appropriate markup. For example, variable cost, manufacturing cost, 60% markup on that. Variable product cost, we want 45% markup on that, and manufacturing cost is we want to 50% markup on that. And we see that these are the prices that we can get it like 796, 793, and 810. And absorption cost is 12% of markup, and we see that 806.40. So these are different ways that we take a base. If base can be of a variable manufacturing cost, base can be a variable product cost, base can be a manufacturing cost, total manufacturing cost, or base can be a that absorption cost. So anything that can be a base, and we have a certain percentage on top of that. Now, common business practices are that most firms use absorption full cost for their cost-based pricing decision because it allows for full recovery of all the cost of the product, and it also it allows for price stability, limit the ability to cut prices, and facilitate planning. And it is simple approach, does not require a detailed analysis of cost behavior. So that's the absorption cost, like the first method, what we discussed, this is full cost per unit. And by this way, it is helpful. That's a common in business practices. Now, the last one, as we discussed, there is a target pricing approach. Then we have a cost plus approach. And now the third one is a product life cycle pricing and costing. So product life cycle spans the time from initial R&D on a product to when customer services and supports are no longer offered on the product, means orphaned. So we can see that uh, since the idea generated for any product from that point till the services are finished, no warranty, no guarantee, no support services, up till that time, or whatever the cost we incurred, we have to take care of all those costs in order to calculate the price, or in order to calculate the cost of that. Life cycle costing tracks and accumulate individual value chain cost attributable to each product from its initial R&D to its customer service and support, the actual cost of to each products from start to finish. This is also called as cradle to grave or worm to tomb costing. So these are the different names we can use for that cost. Now, life cycle budgeting is estimate full product cost across the value chain, including recycling, reuse, and reclamation cost. All revenues and costs associated with the product becomes visible. Percentage of total cost incurred at early stages of life cycle are highlighted. And interrelationship among business functions cost categories are highlighted. Non-production costs are large, like research and development and support services. Important consideration for life cycle budgeting is when the non-production costs are large, like initial research and development and after sales services provided by to the customers, and after setting of reclamation or environmental damages or recycle or all these things. If these costs are very large, then we have to take care of this and we have to use the uh, life cycle budgeting. Development period for our R&D and design is long and costly. Many costs are locked in the research and design stages, even if the R&D and design costs are themselves small. So even the research and development expenses are small, but they lock the, we select a design finally after research and development, that costs high. So that means the locked-in cost is very high because we accepted the material, we accepted the design, we accepted such a things that may cost us a high cost. So here is an example of a life cycle budgeting. Selling price per package, sales quantity in unit is for, if we are assuming these are alternative price scenarios. There are three alternative price scenarios. If we are selling at 400 per unit and we are selling 5,000 units, so the revenue we are generating is 2 million. If we are selling at 480 and we are able to we are able to sell 4,000 units, so we are generating a revenue of 1.920 million. And in third scenario, if we are selling it at 600, so we are able just to sell 2,500, and by this way we are generating 1.5 million revenue. Now, life cycle cost is, we are starting from research and development cost, which is 240 for the first scenario, 240 for second scenario, 240 for third scenario, because research and development is same for all the three scenarios, how much we are charging. So design cost of production process, that's again very same. Then production cost. Production costs are different because we are selling different number of units. So production cost for first scenario is 225, for second scenario it's 200,000, and for third scenario it's 162,500. Marketing cost is again different because we are selling different products, different numbers of products. So 190, 166, and 130. So marketing cost is 130, and then we have a distribution cost that is for sales 130, 114, and 90 million. So that's a 90. Uh, yes, because of that reason, sorry. So it's a 90 million. Customer services cost. Customer services cost is that after sales we are providing services, and we see in this scenario 230,000, 200,000, and 155,000. So total life cycle cost for scenario one is 1.175 million. In the second scenario, it is 1.080 thousand, and in the third scenario, it is 937,500. So this way, when we calculate the net operating income, we see in first scenario, we have an 825,000, 840,000, and 562,500. So we see here that we can select any one of the options out of these three scenarios. We can go for 480 price, and by this way we are making 840, which is higher than 825 and 562. So that's the case that we can. Now, in a life cycle budgeting, we use the word, there are two types of cost, which we call it as upstream cost and downstream cost. Now, upstream cost is a pre-production cost, like for research and development, for designing, for all these things, like upstream cost, pre-production cost of research and development, and or a product and a process designing. So that's a upstream cost. Downstream cost is a post-production cost. incur to make a sale and keep customers satisfied, marketing, distribution, and after sales services. And full product cost is recover all upstream production and downstream cost plus the profit. So that's a full product costing. So this is summarizing in a very effective way that there are there are actually, we divide the whole life cycle into three different costs. One is upstream cost, the other one is downstream cost, and in between there's a production cost. So when we add up all these upstream production and then downstream cost, that and plus profit margin, that is going to be our full product cost. Now, in the end, we going to talk about more economics as compared to the uh, uh, managerial accounting. So price discrimination. Price discrimination is nowadays very common, and we call them price discrimination only if the cost of the products are same but we are selling at different prices. This is the price discrimination. If the cost is different, then it's not a price discrimination. For example, if you are traveling on an aeroplane, so there is a first class, there is a business class, or there is a economy class. Now, the airlines have a different cost for all these three classes. And for that reason, they are charging different prices. If they're charging different prices for these different classes, based on the cost, that is not a price discrimination. What is a price discrimination is that if you are traveling in economy class and you are paying different price, then the one who is sitting beside you is paying a different price. So this is a price discrimination. So we have to keep it in mind that price discrimination is only when the cost is different. When the cost is same. If the cost is different, that is not a price discrimination. So price discriminations are very common nowadays. The objective of price discrimination is that we want to sell more, but we don't want to reduce the price in general. So how we can now price discriminations are also again for two types. One is that we discriminate the price on every unit of our product or a service. For example, if you go to buy insurance for your car or as a health insurance, so when you buy for a car, your insurance, your driving record determines how much cost you have to pay for your insurance, your driving record. And similar is the case with the health insurance, that if you go and you want to buy your health insurance, your health record is going to determine the cost of your health insurance. So it means that every customer is going to pay different price for the same product, like a health insurance, like a car insurance, but the price is different based on individual out. So every product, every single product is going to be sold at different price. But there are some price discrimination which is based on a market segmentation, like we divide the market. For example, if you ride a bus like as a student, and if I ride a bus as an instructor, we are going to same destination, same bus, and we are paying a different price. Now, why we are paying a different price? Because we belongs to different segments of the market. I am a adult and you are a student status. So because of that status, they are discriminating, and that type of discrimination is a market segment discrimination. So the objective is only that they want to increase their revenue, they want to sell more, but not want to reduce the price for everyone. Because in a single price model, if we want to sell more, we want to reduce the price, but that reduction is for everyone. So the practice of charging different customers different prices for the same product or a service, it has some legal implications as well. Like we cannot discriminate within that. Like if we divide the market segment based on some reason, sound reason, like a student status or non-student status, senior citizens and the adults. So in that case, there is a logic, there is a reasoning, and that is legal. But if we are doing a discrimination which has no logical reasoning for that, in that case, it is illegal. It is not allowed. So we have to, when the managers uh, wants to go for a price discrimination, they must have to keep it in mind the legal framework in which they are operating. Then there is a way that we can charge peak load pricing. The practice of charging a higher price for the same product or service when the demand for it approach the physical limit of the capacity to produce that product or a service. Like if there is a high demand for any product, so definitely they're going to charge more price. But it is possible that in some peak periods, the demand is more and they charge more. When there is an off period, then they charge less. And it is very commonly observed in hotels, airlines, like during the summer vacations, the hotels prices, the airlines ticket prices, and all these are very high as compared to off season. Like if someone wants to travel and he can possible to travel in September or in at the second half of a September or October. The prices are very low in hotels and airline tickets. Why? Because that's not a peak load pricing and that's a off-season pricing. So that is also possible that they can discriminate, and we which we observe very normal that off peak and peak load pricing models in price discrimination. So price discrimination is illegal if the intent is to lessen or prevent competition for customers. There is also an idea of that's a legal dimension in price setting is predatory pricing. Predatory pricing is deliberately lowering price below cost in an effort to drive competitors out of the market and restrict supply and then raise pricing or then raising prices. So that's also illegal. Like the objective is not to serve the customer. The objective is to kill or destroy or to like a predator, predatory pricing. That's what we call it. That's why we call it as a predatory pricing. Dumping is also not allowed. Dumping is normally used with reference to trade, international trade. A non-Canadian firm sells, that's why I'm saying that it is used for international trade, like a non-Canadian firm or any firm which are out of the country, firm sells a product in the country, in Canada, at a price below the market value in the country where it is produced. And this lower price materially injures or threaten to materially to an industry in Canada. So if that is the case, that is called dumping, and dumping is not allowed in international trade. If that, in a simple way, we can say that if the exporter say that, okay, I want to capture the market of this importer country, how I can do is if I charge a very low price. So by this way, what is going to happen? My product is going to be very high demand in because the competitors from that country charge high price. My prices are low, and that's that I can capture it. This is not allowed in international trade. Collusive pricing is also not allowed. It's illegally not. Collusive pricing means that when you go for bidding a contract and they know that we are four firms, we are bidding for that contract. So they sit together and say, okay, if we make a collusive pricing, like I quote this much price and you all gonna quote higher than this, and I know that I will get this contract with this my price. So I will share with you some of my profits and you don't need to do anything. So by this way, that is going to be collusive, like they are doing some illicit contract, and by this way, they want to charge more to their customers. So occurs when companies and industry conspire to in their price and production decisions to achieve a price above the competitive price and so restrain trade. The last thing is that we discussed in life cycle budgeting cost approach, in which we have to keep it in mind the environmental or sustainability. If there is any cost, like for example, in oil industry, in oil wells, when we dig or rig a oil well and extract an oil, and that every oil well has a life like a 5 year, 10 year depending upon the availability of oil beneath. So if we figure it out that, okay, this is a 5-year well, but when it is dried, no more oil can be extracted, then we have to reclaim it. We have to spend money to reclaim the area where the oil was rigged, or oil was established for extracting oil. So in that case, that cost should be also considered. So concern about environmental sustainability and extending the view of the life cycle costing. So past and the end of the product life cycle now includes responsible waste disposal. Waste disposal is also very important. Nowadays, the very big challenge for the world is that how they can dispose of their material which they produce, because dumping grounds or these reserves where we have to dump our garbage is filling already over their capacities. So in that case, there is always an issue of disposal of production and disposal of obsolete products. Uh, so we have to keep this in mind, environmental sustainability in their cost, especially the law. Life cycle costing procedure. So this is all what I want to share with you regarding this pricing policy, pricing decisions and profitability and cost management. I hope you enjoyed it. And if you have any question, you can email me or you can write below the comments. Please don't forget to subscribe. Your subscription is going to be helpful for promoting this effort.